All right, yield nerds. This time I am truly getting into tech growth stocks. I've had it. I am going to follow this wonderful gentleman here, the giant among us, and get into AI and tech stocks and find the very best tech stock. Well, we have 333 followers. Thank you so much. And if you're new to the show, please use the playlist. And I say this in every episode, I have no magical powers of prediction. Make sure you check my work. Make sure you make your own decision. And I would love to hear from you if you have comments, especially if you disagree. Well, today's agenda is going to be in 4 parts. We'll take a quick look at the market temperature, and we're going to create a tech filter. And I'm going to still use my value investing principles and look at tech stocks and see what the best of available options there are. And I'm going to play the tech Super Bowl, which kind of is like the yield Super Bowl, except I'm only going to let tech stocks into the door and see who among them is the good one. And I will make some trades based on my conclusions. So having said that, very quick market check. The market is on fire. 12% up year to date, NASDAQ up 16, and my piddly one, is barely up 2%. What is going on? I gotta do something about it. And that is why I figured I'd get into tech stocks. And you may know my portfolio. I'm very heavily in fixed income, but I am moving very rapidly. By that I mean, a couple of trades a week into equities. And this time I figured I would look at tech stocks. And as far as time to maturity, I do have my own thesis on keeping things very, very short term. And so as these treasuries mature and as the market gets some level of volatility, I make my own decisions on slowly getting into various equities. And I do have my collection of agency bonds and some corporate bonds that mature. And so at the end of the day, I figured I need to pay more attention to the tech world because I don't give it enough attention. So I thought I'd create a simple filter. I'm going to review very specific stocks. I want to make sure you know that this is not investment advice. It is not tax advice. I'm not a wealth management advisor. And I also don't have any secret thing that I'm pitching, no products or politics here. Okay, here is my growth filter. It balances a couple of things. I'm not going to go out there and willy-nilly pay for, stuff. It is my own money. I invest with caution. So I'm only going to look at the IT sector with decent volume. I put price to earnings of 30, which in my opinion is very expensive. Price to cash flow of 20, which again is very expensive if you ask me. Net profit margin, if I'm paying that much, you better make a profit. Net profit of at least 15%. Don't like a lot of debt. And I look at US-based companies. To put this in perspective, if you look at something like a TK Tankers, the PE ratio is 4. I'm willing to pay up to 7 times as much. Price to cash flow of 4. I'm willing to pay up to 5 times more for $1 of cash flow. So I'm violating a lot of my value investing techniques because I want to look for the real awesome tech stocks. So I hope the good ones qualify. Let me see what is there. So what I'm really looking for are tech stocks that grow very steadily. However, the higher valuations need to be justified. So I'm not just going to focus on growth. I'm going to start with fundamentals, relax the parameters, and then find ones that grow. And that's my compromise to myself. So let's get ready. Let's play the tech stock Super Bowl. If we were to apply the rules earlier, here are the companies that qualify. How about that? The contestants for the Super Bowl are, and this is in alphabetic order, there are 14 individual stocks that come into the picture. And ACLS, ACM Research, BTCS, Cirrus Logic, InterDigital, Immersion, IPG Photonics, Keysight, Marathon Digital, ON Semiconductor, Photronics, Rambus, Skyworks Solutions, and Teledyne. So that is who we have. And so I figured I can't manage 14 at one time. My mind is too simple for that. So I'm just going to sort them in the order of net profit margin. So I want to look at the most profitable companies first because I don't want to do a lot of work. I want to quickly get to my answer and find the tech stock that not only is growing fast, but is also, making a ton of money. That's what I'm looking for because you're asking me to pay you a lot for your PE ratios. And so I just created 5 leagues. In the descending order of profit margin, I went A, B, C, D, E. And then from the bottom, I start A, B, C, D, E, and right in the middle. So what I thought I would pretty much do is, put them into 5 different brackets. And within each bracket, I'll pick the winners and go from there. And so the Super Bowl champion for tech would be the one that has grown steadily, because we are looking for growth stock, has a good profit, generates good cash flow, because if you do all of that, I am willing to look away and pay a much higher price to cash flow, much higher price to earnings. But I also need to get the comfort that the company is positioned to keep growing into the future. So let's go into the A League. The A League, as you may remember, if I sorted descending in profit, it has 1 from the top 5, 1 from the bottom 5, and 1 from the middle, and that is BTCS, Keys, and ACMR. BTCS is a blockchain protector. Keys does design and testing of semiconductor chips, and ACMR does wafer cleaning. So let's learn all about them. BTCS, it protects blockchain and Bitcoin trades. So this is very exciting. They throw off a lot of profit. What is happening? It doesn't look too good here for BTCS. Looks like the heyday of blockchain software police is gone. People have gone around it. And so this doesn't do anything for me. It doesn't generate a profit. It doesn't generate cash. And so gone. BTCS out of the picture. Let me go to Keys. Keys does electronic design and testing for semiconductors. So instead of actually being the gold miner, this company sells shovels for gold miners. I like that. This is is aligning here, except I see a problem. Instead of steady growth, we have a steady decline, and that doesn't look too good. And I would say I'm not seeing what I came here for. I was hoping to see steady growth, so I'm going to throw out Keys. Let me go to ACMR, again, a shovel maker, if you will, or a jeans maker. And if these terms are not familiar to you, you should watch the previous episode. And we talk about how to identify the shovel makers and the jeans makers and the egg makers that made a lot of money during the gold rush. And so ACMR makes cleaning equipment. I like it. And I look at their stock. Whoa, look at that. They have almost quadrupled in the last 5 years. I'm liking what I'm seeing so far. Look at their revenue in general going up. Right? This is fantastic. And so I wanted to get to know them some more. I went and picked up their 10Q. And what really stuck me is they want to make sure you know that they are not a mainland China operating company. And it was kind of weird that they were talking about what they were not instead of what they are. And then they go on to say our office is in Fremont, California, but we do make a substantial amount of our development, manufacturing, support services in China. And I go, wait, I'm confused here. You're not a China company, but you do a substantial majority of your work in China. And they also own 82% of ACM Shanghai, which is in China. So I'm a little confused. I'm trying to understand what is going on here. And then they say, if any Chinese central government authority were to determine that we are a Chinese company, which, mind you, we're not, even though we do most of our work there, then our common stock could become worthless. Not my cup of tea, ACMR, sorry. So I'm going to go to the B League. In the B League, we have IMMR, which is haptics, all your touch screens out there. RMBS, which is memory chips. And Cirrus Logic, which is codec for audio. Hey, Siri. And so these things sound real good. I'm hoping this is going to work out. And IMMR definitely looks very good. Just by looking at the market cap of 325 and the enterprise value of 135 million, that tells me they have a huge amount of cash in their bank and not a lot of debt at all. I'm liking what I'm seeing. And then I look at their earnings per share. It has these enormous peaks and valleys. I look at their revenue, again, huge peaks and valleys. So I don't quite understand what's happening. And it's not like they reached a new normal, because after reaching this peak, they again crash and go down. So I'm saying, what's going on? Oh, here is what is going on. IMMR just signed a license agreement with Samsung for the next several years, and they got the cash up front, and that's why they saw that huge peak. But then after that, they don't really have a big amount of money coming. That's why their revenue after this year is not high. Okay, so I see where they got their cash from. What are they doing with that cash? And I read a little more, and it turns out Barnes and Noble Education got $95 million through new equity capital, and oh, by the way, also Immersion Corporation. I go, wait, I thought this was a haptics company. What are they doing investing in Barnes and Noble Education? I couldn't quite understand it. So I started understanding Barnes and Noble Education. There must be some AI in Barnes and Noble. That's Barnes and Noble Education. That's probably what they do. So I went and looked at Barnes and Noble Education SEC. Turns out Barnes and Noble Education owns 1,272 bookstores. That makes a lot of sense. Haptic technology, bookstores. So how is Barnes and Noble Education doing? Oh, they are bleeding cash. I see. So tell me more. I thought we were looking at a growth stock. I'm very confused. So you could own both the haptics and also a bookstore that is losing money. Not my cup of tea. That is not what I came here to pay huge price to cash flows on. So now I go to Rambus. This is the kind of stuff I'm looking for. 400% increase in share price. I love it. I look at their cash flows, and something is awry here. The blue line is their stock price. The stock price keeps going up, but their cash flow keeps going down. What does that do to the price to cash flow ratio? Think about it. If your cash flow is down and your stock price is up, their price to cash flow is going exponentially higher. So you're paying more for $1 of cash flow. And then you look at the earnings per share, same problem. Their stock price is going up, earnings per share is going down. Once again, their PE ratio is going astronomically higher. I got a problem here. So a higher share price and a falling cash flow is not what I came here for. I don't know how I can buy them. So I go to Cirrus Logic, and finally, it looks like I've met the perfect company. You can see that they have very steady revenue. Their cash flow had a little bit of a bump, but in general, it seems to be going in the right direction. But looking a little bit closer, you see this weird pattern of 3 quarters up and 1 down, 3 quarters up and 1 down. And you go, why is that? Something must be happening in October, and they are building up to October and then falling off a cliff again. I wonder what happens in October that drives this. And you start researching. Remember, they make audio codecs for smart devices. You read their 10Q. It turns out Apple is practically 90% of their revenue. And you go, whoa, Apple better do well, or Cirrus Logic is going to be toast. And then you look more into their 10Q, and it says, by the way, we really can't even maintain our sales price, maintain our sales, increase our prices, because our customers can stop anytime using our codec with no penalty. And they also don't need to buy a minimum quantity. So this thing is on thin ice, as wonderful a company as it is. Sorry, Cirrus Logic. Moving on. Now we go to the C League. This is some crypto magic secret sauce, Marathon Digital Holdings. Not my cup of tea. IPGP. This looks pretty good. Lasers and semiconductors. And IDCC, which has all the big buzzwords in it. It's Wi-Fi, it's visual, it's AI, tech. I'm hoping I find a winner here. Let me dive deeper. What is IPGP? IPGP is crashing and burning in terms of their share price, down 40% in the last 2 years. I feel terrible. And you look at their revenue, and that tells you the story. IPGP is declining in the revenue every year. They are half of who they were 2 years ago. A wonderful company doing great work, except the manufacturing has shifted outside the US. Their cash flow is declining, down 50%. Their revenue is declining. The story of wonderful American manufacturing companies, even though IPGP is a wonderful company in and of itself, they appear unable to keep their competitive advantage. Sorry, IPGP. So I go to IDCC. This one excites me because it has all the buzzwords: wireless, visual, and artificial intelligence. and they don't have a lot of debt. As a matter of fact, they have 400 million in cash. I'm hoping this is a good one. Whoa, look at that, 80% increase in their share price. I like what I see here. This is probably the American Star. I came here for what's going on there. They again have this, starvation and a huge bump in revenue. Or this is earnings per share. Revenue does the same thing. They make very little, make a huge amount, make very little, make a huge amount. And you go, what do they do? That this is their pattern. And you dive deeper, and it turns out they license their patents. They license their patents to smartphones and automobile companies, and turns out their smartphone share is declining very, very quickly. Their automobile share, their revenue is increasing. However, it is a really small piece of their puzzle. And so the thing that appears to be making a difference is this thing called catch-up revenues. And you go, what's that? Well, it's revenue they thought they were going to make, and they said they were going to make, but they really did not make it. Now you add it. Once you add a catch-up revenue of 166 million, they grow by 25%. If you take that out, they are crashing and burning. Not my cup of tea, folks. What is worse is when they tell you about their forecasts for the next few years, every single year they forecast a decline in revenue, and not really what I came here looking for. So I'm going to pass on that one as well. We're down to the very last two leagues. We have some stars here, I hope. We have PLAB that makes photomasks. We have ACLS that makes implantation equipment, Teledyne, On Semiconductor, and Softworks. So let's see what's there. PLAB, seems to be having a downward trend there, even though they've done well over 5 years. Hey, look at this revenue. I like what I'm seeing here. It's not growing, it's a little bit steady. And so the stock price, however, has doubled. Same problem as before. If your share price is going up, I expect your revenue to go up, your cash flows to go up, and your earnings per share to go up. So PLAB has that problem. And so I started reading their quarterly reports. And it literally says, look, our revenue doesn't go up when the semiconductor sales goes up. Our revenue goes up when customized semiconductors are produced. And once people stop producing customized IC chips, then we go nowhere. And so it's a little bit also a challenge in that it looks like they are very mature and reinforcing that mature thought. When you look at how they make their money, their mainstream, 99% of their revenue base is declining, and they're trying to come up with new products, but their largest segment is having trouble. And their growth is coming from Europe, but the rest of the sector, China, Taiwan, all of those places are declining. And so it's okay, not amazing in my opinion. It's kind of a very, very expensive CalMain, and so this is not something I would want to go to. Then I go to Teledyne. Teledyne seems to be kind of sort of flat. It's 50% up over the last 5 years. But here is my challenge with paying a 50% increase. Their revenue is flat. I wanted to see an increase in revenue. I thought I was buying a growth stock, so that is not for me. We come to our very last company, ACLS. ACLS makes the cookie dough machine that turns around and makes the cookies, which are semiconductor chips. And I like what I see here. Revenue is going up steadily. The stock price is up and down a little bit, so I'm glad I did not own it when the stock price was at an all-time high. Earnings per share is also going up. I kind of like that. Cash flow is also going up. This is what I came to see. I came to see a steady increase. And then I looked at their quarterly reports. It looks like they have several customers. No single customer has like a Cirrus Logic type 90% of our revenue comes from Apple type scenario. I like that as well. And then I start reading more and it says 99% of our revenue comes from a mature segment. And I go, that's interesting. And so they say, hey, we really are counting on this 1% of our business to show us growth. And when you dive deeper, you can see that they are doing some work in trying to improve their margins and moving things around. They do have trouble in the cloud infrastructure area, so they're trying to get into aerospace. They are a small piece of the market. As good as the company is and as stable as they are in market share, they are a very small piece of the puzzle that then makes me ask, who is the big dog in this area? Who else makes the cookie dough machines for semiconductors? Because when I look at their market share and their revenue, it's flat. And so ACLS is sticking to what it makes, who makes a lot of money in this area. And as I started researching, turns out AMAT is the one that makes a huge amount of money. As a matter of fact, AMAT has increased their sales by 101% to China, while the rest of the world is getting hurt by China. AMAT is selling into China, and all of their growth is coming from China. They're losing sales elsewhere, but they are more than making it up by selling into China. And you go, what is that AMAT company? And turns out just as ACLS is going down, AMAT is going up, up and away. And so that informed my trades, and here is what I ended up doing. Yes, I opened a position both in AMAT and ACLS. And of course, I bought some treasuries because that is me. And so here are my holdings. I have the usual defensive sectors, a couple of military, energy, and food. And I got my preferred. And here are my first two tech stocks, ACLS and Applied Materials. So my thesis at the end of the day is that I'm going to sit predominantly in fixed income, but I'm going to look at tech stock, and if I truly think they are worth my while, I will go buy some. Otherwise, I'm going to stay steady in fixed income. Thank you for listening to Yield Nerd. Have a wonderful week.